Hey everybody, welcome back to The Dive. Joining us today on the show is Tavi Costa from Crescat Capital. He's going to share his thoughts on the Credit Suisse event, what's happening with the pound, OPEC announcing cutting oil production and the impact of this on capital markets, as well as he's going to go over a few of his famous charts with us. But before we bring Tavi on, do me one quick favor and just go ahead and tap on that subscribe button for me, please. Hey, Tavi, welcome back to The Dive.
Thanks for having me.
Yeah, thank you so much for joining us again. Okay, so let's start off with the Credit Suisse story. Do you think that social media has turned this into a bigger event than it should have been?
Perhaps. I think that's the usual natural tendency of social media, but I do think there's relevance to the story. I think Credit Suisse has a very large amount of exposure in Asian assets. Back in 2015 or so, when we had shorts in most Chinese names and Asian names, this was one of the vehicles that we use to be expressing that view. And so it doesn't surprise me that some of that is coming to fruition just now. It's been if you look at the chart of Credit Suisse, it's been in a very long-term decline. And the quality of their assets is really masked by the amount of non-performing loans. And this is a problem that happens with most Chinese banks, Hong Kong banks, and so forth, that we've always thought that they're facing. And now that we're seeing most defaults on the housing market in China and other parts of Asia, that's starting to show some of those issues. And so I think there's more to go. As you see, markets are starting to decline in the last month or so, and you're starting to see more and more issues like this. And so we haven't seen yet markets get disorderly as far as a sell-off and as far as the normal economy become more dysfunctional. And I think we're going to get there because the level of tightening that we're seeing is very severe. It's quantitative tightening is at the same time this rise of interest rates, so cost of debt's getting more expensive. You have this dollar move at the same time, and the combination of those three things: central bank liquidity, dollar move, and interest rates moves. That's very, very negative for global liquidity of assets. And so I think more issues like that are going to be more apparent.
Okay. Let's move on here. So the new Prime Minister of Britain, Liz Truss, reversed plans to abolish the top income tax rate of 45% on high earners. What are your thoughts on Britain's economy and what's happening with the pound?
Yeah, they joined the BOJ. That's my opinion. Meaning they decided there are three blocks of countries in the world today. And I acknowledge that that's a very simplistic way of explaining the global environment from a central bank lenses. And what we have right now is, first of all, the Bank of Japan was the first one to lead the way in suppressing the cost of debt. By suppressing the cost of debt, it caused a collapse of the currency. And finally, we're seeing the BOE join the same party, where they were forced to step in a very disorderly manner when it comes to the markets of gilts that were selling off significantly. In order to buy those, almost completely reverse their initial course to save the bond market at the cost of their currency. And so I think there's more to go there on the currency side. The more you protect your bond market, the more you're going to have issues with your currency. Then you have a second block of countries that have been basically putting all aside to really focus on price stability. I think those two countries really are, number one is the US, reserve currency of the world, and Brazil has been doing that as well. So you have the bond market selling off, the bond market in some ways collapsing, treasury market being one example, but their currencies are keeping up, a much better value than other fiat currencies. And then you have a third list of countries that are facing almost both issues all at once. And I think most of those are really Canada, but really the ECB, in other words, most European countries that are facing a collapse of the bond market along with the collapse in their currency market. So there's really not a way around this. I mean, there are so many debt imbalances globally and valuation imbalances globally that central banks are going to have to face one of the two issues. Either they're going to be saving the cost of debt issue by suppressing rates, or they're going to save their currency. And both paths are unsustainable. Inevitably, I would say both issues are going to happen at once. So those countries that are suffering from a collapse in the bond market along with equity markets, that's ultimately where I think we're going to go to. So this is the reason why you want to own tangible assets, one reason why you want to own gold. It's not every decade you want to be doing that. But in this decade that we're entering, I think that's the case.
Okay. Okay, so let's shift and talk a bit more about the US here. OPEC announced that they will be cutting oil production by 2 million barrels per day starting in November. What do you think that the impact of this is on the capital markets?
It's really amazing what's going on in the oil markets because it reflects one more time the issue with natural resource companies as a whole and the whole industry, where you have this pressure from different macro forces on a decline, forcing the prices of those natural resources to decline. Now, it's crazy to think that China is imploding. The Fed is tightening as much as it is tightening. The government in the US is selling strategic petroleum reserves, and oil is holding up its value as much as it is, still at $90 a barrel here in the US with WTI. And then, when you think about it, it really, again, I think it's a issue of how constrained and how tight the market is on the supply side for oil. And I think oil is headed higher. I mean, obviously, when you have a large move in oil prices and energy prices like we've had in the beginning of the year to until, let's say, call it April, it becomes more difficult to make money on that trade. But we've seen a pretty significant pullback, and some of those names are very oversold. I think it's time to be deploying capital back into those. And remember, the commodities market is really predicated on, I think, one major factor, which is the Capex cycle for natural resource companies. And we haven't seen much of that increase. In other words, companies are not spending capital as they did in a prior peak levels of oil prices. And so it's hard to believe we're at peak here when they're not spending capital. And when you adjust that for GDP levels, oh my goodness, they haven't spent anything. $10 million spent in the ground today are not the same as spending $10 million in 2008. We got inflation, labor costs, infrastructure costs. So, I mean, adjusted for those, we're at record lows right now for CapEx for those companies. So I think oil is headed higher.
Okay. We actually wanted to bring up your chart on the CapEx cycle adjusted for GDP here. We're wondering if you could maybe just walk us through what it all means. What are your thoughts with it?
Well, I think it's a critical chart. It shows that we're not where we were back in '08. It shows that we're not where we were back in 2014, 2015, when oil was at peak levels. And today there is this idea that if equity markets collapse, natural resource companies have to collapse along with it. And to me, that's a very, from a basic level, it's like fighting the less war, which I don't recommend anybody to be doing that. While I love cyclicality and looking back in history to understand what possible correlations will look like when you have a decline, and it's undeniable that when you have a real crash in things, correlations goes to one and every asset declines versus the dollar. But I'm not sure that really applies on a long scale of looking back in prior periods when we had other downturns in the economy. So when you look back in the 70s, during times when also supply was very constrained and CapEx cycle was actually very low, well, oil actually performed very different than in '08. And so I don't think this is a time when you want to be not allocating capital there as obviously it carries risk, and risk equals opportunity. But I think it's warrant. I mean, it's extremely cheap. Most oil companies are very cheap. They're paying high dividends. And it's amazing because this chart that you're saying, it shows just the Capex front, which is very, very important. But what about the amount of buybacks and dividends that those companies are doing, which is larger than what they spend on Capex, meaning they're returning more capital to shareholders and investors than investing in their own businesses. What does that tell you about the future of supply of most natural resources? In fact, today, if you look at amount of rigs or rig counts in the US, they're contracting for the first time in 2 to 3 years. And at a time when we're facing a supply shock. And so oil production for the last 3 months is actually slightly down. And so we're not seeing much come online. And I'm a little worried about those issues because they're not being resolved. In a sense, what the Fed is doing by tightening monetary conditions is just making it even more difficult for availability of capital for natural resource companies to be really exploring, developing, and producing resources. And that's a huge deal. So I think this is a very early stage trend that will attract a lot of capital and involves a lot of things. It's not just commodities, it's the value to growth transition, which is probably even bigger wave in terms of attracting capital towards this industry.
Okay. So let's shift to the US job openings chart. What is this telling us?
Well, look, the job opening is we're very focused on labor markets. I'm shifting my view on this, but labor markets are very likely to be in a very tough place, 6 to 12 months from now. So how do you look into this by, it's a very difficult market because most of the gauges in labor markets are kind of backward looking. And so you have to really focus on things that are changing in the margin. And the job openings example is a very good one where we've had in the last 4 months, one of the largest declines in history. The only one that was larger than that was during the March crash when we had the beginning of lockdowns. Of course, the economy was locking down everything. So we had a lot of job openings or a crash in job openings. And now what's happening is way worse than what we saw during the global financial crisis and the tech bust. Just to put into perspective of the level of contraction that we're seeing in that gauge. And so to me, we're starting to see that in initial jobless claims already. I think unemployment rates are extremely delayed in terms of that process. I've done some research back in the 70s. After you have 2 years of an acceleration of inflation, that tends to have an impact on unemployment rates. At least that's what happened in that decade. We've been about 2 years into this appreciation of inflation as a whole. And in my view, we're very close to seeing a large spike in that as well. And so, if you look at announcements of layoffs, that's also increasing. I believe on a year-over-year basis, it's about 70% growth. And so, yes, we've seen this other times when it was kind of a mid-cycle environment. That's not my view. I think we're headed towards a recession, not a mid-cycle correction. And I think that the labor markets are going to be very challenging very soon. But again, what I would refer to changing my view was more to do with how markets haven't yet have to still get very dysfunctional for the Fed to change their stance, and we haven't seen that yet.
Mm-hmm. So, how long do you speculate that a recession could last?
I don't know. I mean, it's tough because I don't necessarily make money on the timing of it, but really the direction of it, and a direction not necessarily of the technicality of a recession, but the direction of asset prices. And so, again, using from my perspective, I think there's more downside for equity markets. I think there's more downside for treasuries. And those markets, I think there's a lot more downside, I should say, more risk towards credit spreads, where we haven't seen yet. Most of the issues in the markets have been created by duration risk, meaning it's really prices of assets being re-rated due to the raise of interest rates. Now, I think we're yet to see the default risk begin to be reflected on prices of risky assets. And when that happens, it's when you see those dysfunctional moments. So I'm waiting for kind of a flush in markets to really see that. And so the way we approach this is that, we know that during the bear market, you're going to have some bear market rallies. So markets decline a lot and it gets, mostly oversold in many technical indicators. And then you have this kind of bear market rally. I think that's kind of what we're seeing now. I thought we're going to see a flush rather than this kind of appreciation we're seeing recently. So from my perspective, when I have those movements in markets, we increase our shorts systematically. So if markets go up 5-7%, I try to match that on my positioning. So because I think overall the direction of markets is actually lower. So I'm not really answering your question from the length of recession, but because that's not how I make money. But it really is from the direction of asset prices that really matters for a money manager. So that's the way I'm approaching this risk and this issue.
So what is your read on the silver market right now?
I mean, I've been bullish in most commodities in general, and you just never know when a commodity will turn. It's been of my view that silver is extremely cheap and the cheapest metal on earth, but that only matters if it's cheap for not indefinite time, and we want that to start moving higher. And I've been accumulating assets in many commodities, not just silver, not just gold, but certainly energy, agricultural commodities, and so forth. I wish I had a lot more oil, for instance, which was the first mover, and lumber was the first mover. But it's just difficult to have that read. Now, silver is overdue, and the more overdue, the more interesting it gets. And so you have an appreciation on a daily basis, like we saw a couple of days ago. It becomes a lot more interesting. You look back in history, the only other time we've had such a large move on the day really was in November of 08. That was not when the market bottomed. That was when the silver market bottomed. And from there, we saw an appreciation of almost 400% for the next 2 years and a half. So in my view, is this the same setup? It's never the same setup. And then people get all hung up and saying, but Tavi, that was a completely different, of course it was a completely different scenario, but you have to use different analogs, knowing the uniqueness of this cycle. And I think your job as an investor is to accumulate and try to express that view the best way as you can. That is what I've been trying to do. I have not given up on any of those positions. They haven't worked recently. That gave me more time and capital to deploy into the space. So I'm very bullish on silver in general. And I do think we're going to go a lot higher. I guess it's a matter of time. And I think the time is as attractive as it gets right now.
Mm-hmm. Okay, now some are saying that the US dollar strength and central bank tightening have weighed heavily on the gold market. With further expected tightening, do you think that this will cause more downside near term?
What worries me is if the precious metals market is moving because it's starting to think that there's going to be a reversal in policies anytime soon. It's not my view. I think there's a huge separation between where the Fed is messaging or sending their own message versus where the market thinks the Fed is going to be 12 months from now. And that's kind of a dangerous dislocation between those two things. And so, in my opinion, I think, on the face of inflation, you would think gold would be doing very well. But then I can create another argument for when you've had a collapse, literally a collapse in global bonds. So bond market has been collapsing globally. On top of it, you've got this move on the dollar in tandem. And knowing the central banks have been withdrawing liquidity to this magnitude, it's hard to believe that gold would perform very well. So I like the way gold is holding up. And I'll give you another example of another asset that has been holding up very well: Brazilian equities. They also have been holding up well. In prior times when we had this level of reversal in policy from ultra easy to ultra hawkish, and some people will say, wow, don't you remember back in the 70s it was way more hawkish? Yeah, but from a delta perspective, is an ultra hawkish. And so when you have that, you would think in prior times, the Brazilian real was trading at much higher levels. The currency collapsed, and it's not collapsing. And so you have some of those really cheap assets that I think are precious metals. And I don't call it emerging markets. I call countries that are commodity-led economies, because they're emerging markets that are actually commodity importers. And that's not good in my view. And so if you find those assets, you're starting to see they're so undervalued, so cheap, that they're not moving lower and in a relative basis with other risky assets. And so to me, that's just the beginning of a market signal, or signaling that perhaps a turn is very close. So yeah, I keep accumulating assets in those two buckets: really precious metals, the large one, commodities, commodity-led economies like Brazil, and I will keep selling things that are expensive. And I think I think the worst is behind us for precious metals. Silver was having its worst year in 30 years, not too long ago. And so when you look at the year to date performance, and so to me, it's hard to believe we're going to see another downward move like this. And if it is down, it's probably, I think it's hard to believe it's going to be as down as or as bad as it was this year. So, it makes me very bullish. And I will keep, focus on that part of the market, because I think that's really the long opportunity is on that side.
Okay. So one more question before we let you go here, Tavi. What do you think will ignite the next bull run in gold?
I think it has to be a total collapse of the global economy, which not total collapse, it's not the end of the world, but really a real severe recession globally. And I think it's coming because, as I said earlier, when you have a bond market collapsing and you have the dollar moving the way it is, and you have central bank liquidity drying up, those three things are unsustainable, especially all together. And so it's hard to believe the economy will sustain the strength that it had been in the prior years. And if you think that that's going to be the case, you're going to see severe recession. I don't think the Fed can be doing as much as they have been doing recently when it comes to tightening monetary conditions. And that's what causes the turn. In prior decades that are inflationary decades, I mean, inflation is the inflation gene is out of the bottle already. And when you have that, the only way you can put that back on is really by completely killing the economy. And why is that? Because you start seeing businesses that they are facing their own contraction of activity, and their first reaction to this now is to do what? Is to raise prices, because the consumer is now more used to those changes. And so, this is a kind of reflexive environment that I think it becomes a vicious cycle on inflation. That's why inflation is such I think developed economies don't know much about this, because they haven't lived through, and most investors have not lived through those eras. And they've been using charts of the last 2 decades to point or where inflation is going to be 12 months from now, but that's the wrong era to be looking at it. It's I think it's a very bad analysis, my 2 cents. And so if you're in an environment where you have, the political aspect completely constrained, where they can't really raise rates sustainably because it would crush the bond market, would crush the equity market altogether, then you have to let inflation run in the system. And if you're going to let inflation run in the system, it's just hard to believe that gold is gonna be penalized in this environment. It's probably going to be very favorable for those things. And people will say, but why hasn't been? Well, because the Fed has been in the first step of really tightening monetary conditions. Can that be sustainable over time? We're talking 5 to 10 years. I don't think so. So, as an investor, you start planning your next 5 to 10 years on what's that going to look like. And, to me, is you want to be looking for very cheap ways to express your view on precious metals where you can make a lot of money, meaning where you can get very exceptional returns if you are in a bull market cycle for commodities and precious metals. And that's where I think that real opportunity lies ahead.
Okay, great. Well, that's all we have for you today. Thank you so much for coming on and sharing your insights with us today, Tavi.
My pleasure. Thanks for having me.
Thanks so much for tuning in today. We'll be back again tomorrow with the silver guru himself, David Morgan. You're not going to want to miss it, so be sure to hit that notification bell and subscribe below before you leave. Bye.